Hey everybody, it's Wayne. Thanks for tuning in. I've got a hypothetical question for you. If you had $10,000 saved up and you were looking to begin your investing journey, would you invest it in popular ETFs such as SCHD or JEPI? Would you take that 10K and maybe buy a series of quality blue chip stocks like Apple, Coca-Cola, Johnson & Johnson? Or would you maybe take advantage of some of the higher interest yielding APRs that are offered by Robinhood, M1, and maybe even your own bank account? Today I want to talk about maybe another option you should consider, and that is running the wheel strategy. So we're going to go ahead and talk about what I am going to start, and I have chosen two stocks to run the wheel strategy on. So before we begin, let's go ahead and cover some basics. The cash secured put side of it. You are entering a contract to buy 100 shares of a stock at an agreed upon strike price with an expiration date. Now you must have the cash collateral in your brokerage. And in doing so, the party who sells the cash secured put will receive a cash premium. The premium is yours to keep regardless if you're assigned or if that contract expires worthless. Now, it's important to understand implied volatility and other stock factors, such as ex-dividend date, earnings date. Now, on the covered call side of things, you are entering a contract to sell 100 shares of a stock at an agreed upon strike price with an expiration date. And in doing so, the party who sells the covered call will receive a cash premium. Once again, this premium is yours to keep regardless if you are assigned or if the contract expires worthless. Again, it's important to understand implied volatility and other stock factors such as ex-dividend date and earnings date. Now, first and most importantly, with the wheel strategy, you must feel comfortable with owning 100 shares of that stock. Make sure that you are only running the wheel strategy on a stock that you will be okay holding long term, especially if the value of that share price fell below your cost basis. This requires you to conduct research on the stock or stocks that you intend to run the wheel on. So here we have it, guys. This is the perfect graphic that illustrates what the wheel strategy is. And it starts at the very top here. When you choose a stock that you want to run the wheel strategy on, you are going to sell puts, meaning you are entering a contract in which you receive a cash premium. And if you are assigned that stock, then you're going to turn around and begin to sell covered calls, once again collecting cash premium. And you'll continue to do so until you are assigned. If you are assigned and those shares are called away, guess what? You restart and repeat the process, starting with selling cash secured puts. So let's go ahead and jump into the pros and cons of the wheel strategy. When it comes to cash secured puts, it's expensive, guys. Not everybody may have the cash collateral for those 100 shares. Another consideration, the stock price could fall significantly below your strike price, forcing assignment that comes with built-in realized loss. This is why you want to make sure that you're choosing a quality stock. It's also important to know how to roll or buy to close your position. So make sure that you guys are doing tons of research. There is fantastic content out there regarding the wheel strategy. Another consideration is the stock price could increase, forcing you to need more cash collateral. For example, let's say you begun to run the wheel strategy on Tesla and the current share price is 180, but in a few weeks, Tesla has slowly increased to 200 bucks. Well, that means if you want to run the wheel strategy and it goes from 180 a share to 200, you now need $20,000 versus $18,000. Now, when it comes to selling covered calls, you are capping any potential profits from share price appreciation. Again, I go back to that Tesla example. I have 100 shares of Tesla. My cost basis is $180 per share. If I sell a covered call for a 185 strike price and Tesla subsequently shoots to the moon and goes to 210, well, I don't get to participate in any of that upside. I am forced to sell my shares at the 185 strike price. And the person who bought the call, they now have built-in unrealized gains. And so that is something you have to consider when running the wheel strategy. You are also potentially missing out on collecting dividends. So if you are going to wheel a stock that has a dividend, depending on where you're at in that wheel strategy, you may not be able to collect on that dividend. So let's go ahead and break down my 5 factors in choosing a stock to run the wheel strategy on. First and foremost, it has to be a quality stock. And guys, I'm fully aware that what I consider to be a quality stock may not be a quality stock to you. So this is often subjective. Next, the current stock price does not exceed 115 a share. Because I am running the wheel strategy on 2 stocks, that means I have to have double the collateral. So currently, I am capping the stock share price at 115 a share. But I am here to tell you guys that there is a lot of quality stocks that are under $100 where you can make some decent premium. Next, stocks that have elevated implied volatility, known as IV. I am looking at wheeling stocks that have an IV of 35% or higher. And this is actually easy information to learn about if you head over to optionseducation.org. You'll also be able to enter in the stock ticker, and it'll break down what the IV is for that stock, what it's looked like in the last 10 days, 30 days, 60 days, and so much more. So it's a great resource. Next, that stock has to offer weekly options. I am not interested in running the wheel strategy on a stock that only offers monthly options. I want to be able to run options on a weekly basis. And last but not least, it's going to sound crazy, but I do not want to run the wheel strategy on a stock that pays a dividend. This goes back to an earlier concern that you need to be aware of when you are selling options. If I am running the wheel strategy on a stock that pays a dividend and that option expires the same week, maybe even the same day as a ex-dividend date, that could cause my stock, right, to shoot up in share price. It could also cause the stock price to fall in value if it's the following day after ex-dividend date. So for me, it's one more thing that I don't want to worry about. I would much rather choose a stock that does not pay a dividend. So let's go ahead and get into the first stock that I have decided to wheel, and it's Amazon, stock ticker AMZN. Let's go ahead and run down these check boxes and see if it meets all of my standards. Do I consider it to be a quality stock? I do. As a matter of fact, I currently own about 600 shares of Amazon, and I've actively been selling covered calls and cash secured puts as it is. Now, the current share price is $103, so that does meet the below 115 per share price. Implied volatility is currently 49%, and that's at looking at the previous 30 days. Amazon also offers weekly options, which is a plus, and it does not pay a dividend. And again, you guys might think I'm crazy on this, but it's one less thing that I want to worry about when I'm running the wheel option. So let's go ahead and talk about stock number 2 that I am running the wheel strategy on, and that is Celsius, stock ticker CELH. Let's go ahead and run down these check boxes and see if it meets those standards. Do I consider Celsius to be a quality stock? I do. And as a matter of fact, I actively own 100 shares of Celsius, and I've been selling covered calls and cash secured puts against Celsius for the past year. Now, the current share price is $92.13. So again, it does meet that threshold as being a stock under a share price of $115. Implied volatility is 50%. This is looking at the previous 30 days. Weekly options, guys, this is why I'm really excited to run the wheel strategy on Celsius, because just in 2023, they transitioned from monthly options only to now weekly options. And again, like Amazon, Celsius does not pay a dividend, which for me, running the wheel strategy, in my opinion, is a good thing. All right, let's give you guys a glimpse of the first transaction of me running the wheel strategy on Celsius. You guys can see here on my spreadsheet, I'm keeping track of information to include the date that I opened that contract, the name of the stock, the option type, right? So CSP for cash secured put, or CC for covered call. I'm noting the strike price, the expiration, how much I received in premium. If I had bought to close that contract earlier, then obviously the difference between the open and buy would result in the net. And then obviously the date that contract either was closed early or expired, and then the total number of days that it was open. Now, as it turns out, there was no buy to close amount because this was assigned to me on the 3rd of February. So I earned a total of $95 in cash premium. And again, I now own 100 shares of Celsius for the strike price of $93 a share. So let's go ahead and give you guys a look as to how this unfolded within the Robinhood app. You guys can see here at the bottom of your screen on the 26th, I entered an agreement. I sold a cash secured put for a strike price of $93. In doing so, I am agreeing to buy 100 shares if the stock price falls below $93 by the 3rd of February. And in doing so, I received a $95 premium that immediately gets deposited into my brokerage account. At the top of the history, you guys will see that there is a Celsius $93 put assignment. And if we open up that information, it breaks down that when the markets closed on February 3rd, the Celsius price was $92.13, so below the strike price of 93, which means I was forced to take assignment on this contract. So now I own 100 shares of Celsius. So now that I've been assigned 100 shares of Celsius and my cost basis is $93 a share, I want to turn around and run the wheel strategy. I've been assigned on the cash secured put. Now it's time to start selling covered calls against the position. So within Robinhood, I'm going to go ahead and select on trade options. This is going to bring me to my options chain. And again, I want to sell either cash secured puts or calls on a weekly basis. So next Friday is February 10th. I want to sell a covered call, and my cost basis on each of those 100 shares is $93 each. So I've got some options here. I can sell a covered call and the strike price be $93. And in doing so, you guys see here, $2.70, you have to multiply that by 100. So I would receive $270. I would break even if those shares were called away from me. I also have some additional options. Let's say I anticipate Celsius going up in value. Maybe I think that Celsius is going to go closer to $94 by the end of next week. Maybe I would then want to choose the $94 strike price. Again, my cost basis is $93 a share, so that would immediately mean if I am assigned, I would make $100, right, on the value of the stock, and in turn, I would receive $233. So this is why it's really important to understand the options chain. Now, if I don't expect Celsius to go above that $93 strike price, then I'm probably going to choose the higher premium. I'm not going to select the $94 strike price if I don't expect or anticipate Celsius going above the 93. I would want to instead earn more premium. And guys, if it turns out by next Friday the 10th, let's say Celsius goes all the way up to $92.99, I would not have my shares called away because again, the strike price did not reach or exceed $93. And again, I would keep my $270 cash premium and I would essentially repeat the entire process. And now I would go out to the following week. And you guys can see here, I would once again have some options that are presented to me in the form of premium. So let's go ahead and now give you a breakdown on the first cash secured put that I've sold on my second stock that I intend to wheel, and that is Amazon. Once again, looking at my spreadsheet, I have already entered a cash secured put contract. So I opened it on the 3rd of February. The strike price is $104. It expires next Friday the 10th. And then doing so, I earned a $116 premium. So let's go ahead and now look at this information from the Robinhood brokerage. Again, I'm going to click on the most recent item under history. And again, guys, it's breaking down the same information. I have sold a cash secured put. If the strike price goes below 104, then I am going to be assigned this stock. And in entering this contract, I received a premium of $116. So how are things looking even though I just opened up this contract a few days ago? If we go back and look at Amazon, Amazon is currently in the red and it is below my 104 strike price, which means if Amazon continues to finish below the $104 strike price, I would be forced to buy 100 shares of Amazon, not at the current share price, but at the agreed upon strike price of 104. So I'm very excited, guys, to share my journey with doing the wheel strategy on both Celsius and Amazon. A question that you may have is, Wayne, how much money do you expect to make in premiums on a weekly basis? And for me, my goal right now is to make at least $200 on a weekly basis. Let's see how that turned out with my first week. Here you guys see that I sold a cash secured put that was assigned to me. I made $95 on this transaction. If we look at Amazon, the first transaction of the week, I made $116. So that's a total for the first week of running the wheel, $211 I made in premium. But it is important to note, I had to have a total of $19,700 in cash collateral. So I am going to keep track of not only the cash premiums that I'm receiving, but also how much cash collateral I had to have in return. So thanks so much, guys, for tuning in. I'm really excited to see how this turns out. I'm very, very optimistic, but we'll see how it unfolds. So you'll have to make sure that you follow along to catch those updates. And if you guys have any questions or comments, feel free to leave them down below.